Crown to dust downfall of America's largest bank. The 2008 financial crisis is still regarded as one of the worst economic disasters in contemporary history. Washington Mutual WAMU, the biggest bank failure in American history, was one of its many victims. WAMU was once a dominant force in banking, but its demise exemplified the perils of unbridled expansion, reckless lending, and regulatory failures. The growth of WAMU, the reasons for its demise, and the lessons the banking sector is still learning from it will all be covered in this video. Number 7. Washington Mutual's ascent. How did one of America's biggest banks develop from a little home lending organization founded after a fire? With the modest objective of giving house loans to people after the Great Seattle Fire, Washington Mutual was founded in Seattle, Washington, in 1889. WAMU expanded gradually during the next century, finally rising to prominence as a major savings and loan organization. Throughout the 1990s and the first part of the 2000s, it bought a large number of smaller banks and financial institutions as part of its acquisition-heavy expansion strategy. Washington Mutual was one of the biggest banks in the U.S. by 2005, with more than 2,200 branches, $307 billion in assets, and a stellar reputation for customer service. The bank positioned itself as a financial behemoth and was a prominent participant in retail banking, credit cards, and mortgages. Number 6. The housing boom and dangerous behaviors. The early 2000s housing bubble, where WAMU used aggressive lending methods to profit from rising property prices, may have contributed to its demise. The bank made significant investments in high-risk products targeted at consumers with lower credit scores, such as home equity loans and subprime mortgages. These loans promised high profits, but there was a significant default risk. WAMU used an originate-to-sell strategy, combining hazardous mortgages into securities and offering them for sale to investors in order to maintain its explosive expansion. This strategy led to systemic weaknesses, even though it produced enormous short-term gains. WAMU's corporate culture partially contributed to its former workers have reported a work climate that prioritized large sales volumes over careful underwriting. Risky loans proliferated as a result of pressure on mortgage officers to approve loans without doing enough due diligence. Number 5. The red flags. If investors and authorities had stepped in sooner, may WAMU's demise have been avoided? When the property market declined in 2007, WAMU's approach started to exhibit weaknesses, and subprime mortgage defaults began to increase. The bank's financial soundness was undermined when WAMU's mortgage-backed assets saw a sharp decline in value. Investors and analysts lost faith in WAMU as a result of their worries over the caliber of the bank's loan portfolio. After hitting a high of more than $30 per share in 2007, the bank's stock price started to plummet, and depositors became more skeptical of its viability. When the U.S. economy fell into a severe recession in 2008, the situation deteriorated. Default rates skyrocketed, and housing values kept declining. By mid-September 2008, WAMU's financial situation had significantly deteriorated as consumers withdrew $16.7 billion in deposits over 10 days, resulting in a classic bank run. Number 4. Seizures and regulatory intervention. On September 25, 2008, the Office of Thrift Supervision (OTS) seized Washington Mutual due to its fast deposit withdrawal and unstable financial standing. The assets of the bank were sold to J.P. Morgan Chase for $1.9 billion, and the Federal Deposit Insurance Corporation (FDIC) was designated as the receiver. At the time of its demise, WAMU had $188 billion in deposits and $307 billion in assets, making it the biggest bank failure in American history. Because J.P. Morgan Chase absorbed the bulk of WAMU's losses, the FDIC was able to handle the problem without using public cash, unlike past bank failures. However, the loss left shareholders with nothing, and it led to several lawsuits and investigations into the bank's operations and the authorities' participation in its downfall. Number 3. Legacy and impact. Was the financial industry more secure or more vulnerable as a result of Washington Mutual's failure? The collapse of Washington Mutual shook the financial sector and had several significant repercussions. Industry consolidation. WAMU's demise hastened the trend of consolidation in the banking industry. The purchase of WAMU by J.P. Morgan Chase strengthened the company's standing as one of the biggest banks in the nation. Such consolidation, according to critics, raised the dangers connected to too big to fail organizations. There have been losses to depositors and investors. The FDIC protected depositors, but shareholders and bondholders suffered enormous losses. WAMU's shares lost billions of dollars in investor capital, making it all but worthless. Reforms in regulation. WAMU's and other institutions' collapse during the crisis brought attention to the regulatory framework's flaws. As a result, the Dodd-Frank Wall Street Reform and Consumer Protection Act was introduced in 2010 with the intention of strengthening financial institution oversight and lowering systemic risks. Protection for consumers. A major contributing factor to WAMU's demise was the crisis, which prompted the establishment of the Consumer Financial Protection Bureau, CFPB, to protect consumers from predatory lending practices. Number 2. Important takeaways from WAMU's failure. What can the largest bank failure in American history teach us about modern banks? The demise of Washington Mutual provides regulators and the banking sector with a number of lessons. The perils of excessive leverage. WAMU was extremely susceptible to changes in the market because of its over-reliance on mortgage-backed securities and subprime loans. Some of the risks may have been reduced with a more diversified portfolio. The value of effective governance. WAMU's ethos of prioritizing expansion over risk management significantly contributed to its downfall. Long-term sustainability requires moral leadership and sound administration. Number 1. Comparisons to modern banking challenges. In a climate of increasing interest rates and economic instability, might another WAMU-style collapse happen today? The lessons from WAMU's failure remain applicable today, especially as banks handle problems such as increasing interest rates, economic instability, and altering customer expectations. While regulatory measures have stabilized the banking sector, doubts persist about whether the industry is genuinely shielded from another catastrophic disaster. We can better negotiate the intricacies of the contemporary financial environment and endeavor to stop history from happening again by comprehending the elements that contributed to WAMU's demise. Subscribe now for expert insights, compelling stories, and exclusive content. Your gateway to knowledge, inspiration, and endless possibilities.